Chris, I was reading this weekend, being bearish doesn't sell these days. In social media, if you're not bullish, you're out. So this is a risky proposition. Tell me about some of the names that you think, well, let's start with some of the metrics anyway, that you think people should be focused on in terms of sort of treading cautiously.
Yeah, hi, Kelly. Thanks for having me on. Yeah, so, not every stock in the S&P 500 is always going to be an outperformer. And so we developed a 7-metric model based on earnings quality that tries to predict which stocks are going to underperform looking out over the next 6 to 12 months. And it looks for items where growth may be slowing, there may be margin pressure ahead, and tries to predict potential underperformance. Things like capital spending trends or inventory builds and so forth. And we standardize it in an overall score, 0 to 100. And the idea is the companies with a score below 20 are expected to underperform. We've regularly tested it empirically, historically, and it works quite well in most market environments.
And so as an example of companies that have recently underperformed by these metrics, you include Boston Beer, SAM, ticker, which we've sort of really covered what happened going back to their earnings this year in the seltzer category, started to slow. The stock has been really hit. Grocery Outlet and Stitch Fix. So these are three names that are sort of confirming the way that you're analyzing companies. Is that right?
Yeah, the common thing among those companies from our work was working capital was starting to build. Inventories were rising a bit relative to trend. There was, in some cases, higher capital spending, which tends to be a contraindicator, and it built over time and led to ultimately disappointing results. And so by following the balance sheet and looking at cash flow, and if cash flow is a little bit weaker than earnings, you can try to spot these blowups before they occur, because when the blowups do occur, they tend to be torpedoes to the downside. And we believe strongly that while Wall Street spends a lot of time telling you what to buy, we can also help investors with telling them to avoid over the near term.